Nigeria's economy sprung a surprise on analysts as it expanded 4.23% year-on-year in the second quarter 2025. Also, its quickest pace in about 4 years, helped by much higher oil output and stronger performance, especially in the industrial sector. The release also reflects a rebasing of gross domestic product, which adjusts for some structural changes which had distorted previous readings. Investors observing the Africa Renaissance will be delighted to see progress, though analysts remain divided on what the target of GDP growth needs to be and to what extent rebasing elevates the numbers and may be masking some weak spots. The Central Bank of Nigeria cut its key lending rate for the first time since 2020 by 50 basis points to 27% as inflation continues to decline. The hikes came after 3 hold decisions so far this year and 6 hikes in 2024. The MPC reduced the cash reserve ratio for deposit money banks to 45% from 50%, but also introduced a cash reserve ratio of 75% on non-treasury single account public sector funds, all to improve treasury management. The Apex Bank painted a positive outlook on macroeconomic indicators, expecting more disinflation, but was sparse on specific forecasts. Senior analysts Tilewa Adebajo, CEO, CFG Advisory, and Opeyemi Agbaje, CEO, RTC Advisory, and Chairman of the Nigerian National Pension Commission, PenCom, expressed their views on the economy ahead of the CBN monetary policy decision to cut rates. Hello, this is Global Business Insights, where we probe in more depth into the context and main headlines and share perspectives on some of the current issues moving markets. The GDP print is a lagging indicator. We know that. It shows, however, that the 4.23% year-on-year Q2 print released was higher than the 3.48% recorded a year earlier. That's quite a leap. The significant agriculture sector grew by 2.82%, an improvement from the 2.6% recorded in the corresponding quarter of 2024, while the industry sector grew by 7.45%, from 3.72% recorded in Q2 2024. The largest contributor to GDP, that is services, recorded growth of 3.94% from 3.83% in Q2 2024. The more labor-sensitive manufacturing sector did see a negative trend. Real GDP growth in the manufacturing sector, Q2 2025 was 1.6% year-on-year, lower than the preceding quarter by 0.09 percentage points. On a quarter-by-quarter basis, the growth rate of manufacturing activity stood at minus 15.81%. Indeed, the real contribution to GDP for manufacturing in the 2025 second quarter was 7.81%, much lower than the 9.62% recorded in Q1 2025. The construction sector also saw nominal growth quarter-on-quarter, recording a minus 20.56% change. That's quite a huge drop. If you navigate details, you will see drops in quarter-on-quarter growth, showing at best a flatness in many subsectors on a quarter-on-quarter basis, which may suggest what many analysts are suspecting, that the year-on-year uptick is driven significantly by a rebasing effect. My view has always been that instead of talking up an unstoppable economy narrative and rehashing old solutions, as tends to be the case amongst the political, intellectual, and entrepreneurial elite, driven by narrow opportunity corridors, we need to invest in and call for more data to interrogate the outlook in more detail, be able to address some of the lingering cracks. Possibly monthly sectoral GDP growth data, employment data, jobs added data on a sector by sector basis, poverty data, literacy statistics, children enrolled in school, access to minimum years of education, access to steady electricity, and so on. We need to address the weaker manufacturing sector, for example, and revive electricity generation, transmission, and supply. Without much more data, it has to be impossible to conclude on things like inclusiveness and the broader well-being of citizens, who may find some of these spikes in GDP at conflict with daily living realities, if not outrightly deceptive. But analysts and investors are encouraged, even if some insist that these are just baby steps in the right direction. Lowering inflation further and cost of borrowing has to be a priority. Certainly, the recent rate cut by the central bank will help to get a broader growth, which positively impacts the more interest rate sensitive manufacturing sector.
One is, it's clear, 4.23% growth. I didn't even expect that crossing 4% growth this soon. So it's certainly good evidence of stabilization, economic stabilization. It's good evidence of accelerating growth. It's another piece of evidence that the reforms are beginning to show very positive results. In particular, it is good to note that all, whether agriculture, whether services, whether industry, the growth rates in all of these dimensions, in these sub-sectors of GDP was stronger now than in the previous year. The growth in industry, from about 3% growth rate to over 7%, is particularly important for me. That's beginning to reflect resurgence of production and output in industry, and that's very good. Services remains the most robust segment of our economy, not surprisingly, and agriculture growth still suboptimal in my view, but is beginning to improve. So these are all very positive signs. The question about whether the growth is inclusive, and then whether there's any evidence of that, such evidence will lag actual development. So we would begin to look at evidence in retrospect. But we know for certain that if all sectors are growing in a broader sense, if GDP growth itself is typically accompanied by employment, a sector will not grow. It is most likely that when a sector's growth rate is increasing, it tends to be that there's greater production, greater investment, and greater employment. That I would take. We know that from economic principles, and we can be sure that when we have an opportunity to make a detailed review of the GDP data that has just been released, we would find that indeed there is greater investment in those sectors, there is greater output in those sectors, which is what GDP is, and there is greater employment in those sectors. It's also wide broad-based, relatively, based on the first evidences we're seeing. So, for instance, agriculture is growing, industry is growing, services is growing. All of this is broad-based, and it tends to reflect in greater employment in services, in farm work, in industry. All of these are positive for employment, for wages, and so on. So I would not be surprised that that we would have a scenario that reflects greater employment and greater, more broad-based growth. Now, final point I would like to make is that I built a scenario. I just presented a scenario at a conference a few days ago in which I argued that 4.5% GDP growth will be one of the signals to a more optimistic scenario for the Nigerian economy. Now we get 4.23%. Yes, one quarter yet. Let's say 4.2, 4.5 is consistent, and then we can begin to think of the advent of signs of recovery, not just stabilization.
While the GDP growth is quite encouraging at 4%, it is clearly not enough for an economy of 200 million Nigerians. And with the level of inflation where it is, it has impoverished a lot of Nigerians and literally wiped out the middle class. So I think it's important that in order for us to have our economy on a sustainable basis and for us to have inclusive growth, we have to begin to see 8 to 10% growth on a sustainable basis. I think that will be the most optimum growth for a country like Nigeria. And if you take a look at the sectors that are growing, there's a disproportionate amount of issues within certain sectors, and it is quite clear that, of course, the oil industry has recovered significantly. But at the end of the day, inflation becomes a problem. We cannot begin to see inclusive growth until inflation drops to at least 12% or below. So it is important that the government should not only focus on these growth numbers, but if inflation gets to 12%, then we can begin to move a significant amount of people out of poverty and recreate a middle class. But right now, without 8 to 10% growth and 12% inflation, inclusive growth remains a mirage.
To more business stories. Gold hits a fresh record as stocks cooled after a tech-fueled run pushed the S&P 500 to yet another high. Nvidia announced plans to invest a whopping $100 billion in OpenAI in return for a significant stake in the ChatGPT maker as part of a joint effort to build data centers for artificial intelligence, also sparking a chips rally today. It could be the largest ever investment in a private company, reflecting the vast resources the 4.5 trillion chip giant wields as the world's most valuable company. The deal ensures that Nvidia stays at the heart of OpenAI's products for years to come. We also got some good news from the OECD, now seeing global growth of 3.2% this year, compared to the 2.9% expansion it had forecast in June, adding that global growth was more resilient than anticipated in the first half of 2025, especially in many emerging market economies. Today, we did get some PMI updates. Eurozone's manufacturing sector contracted unexpectedly in September, while services activity accelerated. Also, data from Germany showed a similar trend, with the manufacturing sector's reversal offset by a strong performance in services, while in France, both the manufacturing and services sectors contracted, increasing concerns about the region's second largest economy. September economic activity in the UK's private sector expanded at a softer pace than in August, as the S&P Global Composite PMI sank to 51 from 53.5, also worse than the market expectation of 52.7. Manufacturing PMI fell to 46.2 from 47, while services PMI also edged lower to 51.9 from 54.2. Chris Williamson, the chief business economist at S&P Global Market Intelligence, described the survey as bringing a litany of worrying news. US S&P September Global's composite PMI ticked down to 53.6 from 54.6 in August. Manufacturing still in growth territory, despite the PMI easing to 52 from 53, signaling waning momentum, while services PMI also slipped to 53.9 from 54.5, suggesting easing demand. Asia-Pacific markets were mixed as traders ride an AI-driven surge. Well, that's all on this episode of Global Business Insights. This is Bode Oshosami. Thanks for watching. Bye.